Hey guys, Toby Mathis here, and today we're going to talk about 3 steps you can take to build a passive income empire. Right now, I'm not joking about this either. If you follow these rules, it's pretty much inevitable that you're going to be very, very wealthy if you put the work in and get it done. It's just all about buying assets, and I'll just be very, very clear. Assets put money in your pocket, liabilities take money out of your pocket. So, the easiest way to tell whether something is an asset or a liability is you look at your monthly bank statement. If it's not doing anything, chances are it's not an asset. If it's taking money out of your account, chances are it's a liability. If it's paying you, whether it be quarterly, monthly, annually, whatever it is, if it's putting money in your account, it's an asset. And if we use that very, very simple definition, then I get to start asking you questions about what you think of certain items, like is a car an asset or a liability? And if you start playing the depends game with me, I'm going to just look at you really funny. I'm going to do this, right? No, it's a liability, period. RVs, boats, all these fun things that we like to say are assets and put it on our financial statement are liabilities. My furniture is a nothing. It's neutral, right? It's not, but it is definitely not an asset. My that rental property I purchased, it might be either or. I don't know. I'd have to look at your bank statement, right? Is it cash flow positive or is it taking money out of your account to operate? 2007, 2008, we had this massive real estate crash. Why? Because people were buying all these houses. Oh, there'll be rental properties, and they could not rent for what they cost. In other words, the cost of the debt, cost of the real estate taxes, the cost of the insurance, the cost of the repairs, the maintenance, the property managers, all that stuff added up to being more than the rents brought in. Some cases you couldn't even rent it. So the whole idea is figuring out what is an asset and what is a liability. Once you can do that, then we can start narrowing it down even further. What's a passive asset? Well, I am a tax attorney, and so I look at the 5 types of income and I call them infinity income types. In other words, they never go away. They continue to keep getting paid so long as you're involved in that activity. And they are rents, royalties, dividends, interest, and I'm going to give you a fifth category, short-term capital gains, and it's specifically on writing covered calls or renting out your stock portfolio. Rents, royalties, dividends, interest, short-term capital gains. That is it. Those are the 5 that I focus on, and we're going to talk about 2 of them just to get started. The first 2 is going to be a big step for a lot of you guys, but if you start doing it and you do it consistently, you will get absolutely phenomenal results over time. So let's talk about this. Rule number 1 or step number 1. So let's just break it down. I call it the 70-30 rule. And this is the you should have been doing it yesterday rule, right? 70-30 means live off of 70% of what you take home. Take the other 30%. I will write this out, but I'm just going to orally or verbally say it to you now. You live off of 70, and then that 30% that's left over, you're going to give away 10% if you can. If you cannot, then we'll talk about putting time in instead. But you got to do some good things. There's this little thing called karma out there, whether you think it's real or not. What I'm saying as a tax attorney who literally reviews high net worth returns day in and day out on literally it's about 10,000 a year that our firm does, and I've looked at over 100,000. When you are looking at those returns, you see trends that are consistent. And I'll tell you what a major trend is: giving. So 10% for giving. 10% pay down debt. This is extra payments on your debt. If you are paying $50 a month towards a credit card bill, this is, hey, what's the extra? What's 10%? Hey, I'm making $3,000 a month take home. Great. Take $300 and pay that thing off. The other trend I notice consistently on the ultra wealthy is they hate debt. The only debt they like is when it's actually a net positive to them. In other words, I can borrow money at 4% and I can make 10% on that money. The asset is paying the debt, not me. You never want to be paying debt. You personally want to get out of debt. In other words, I don't want to have personal credit cards. Frankly, I don't even want a mortgage on my house. I don't want to have debt. But if my business or if I have an asset that's paying for itself, I'm okay with that. In other words, if I have a rental property, but that rental property is paying off any mortgages on it and still paying me, it's an asset. I'm okay with that. But we're going to take that 10%, we're going to pay down our personal debt. The other 10%, boom, 10% goes into investing. And I know there's people out there that are like, but I barely make it, etc. I know. You're going to work your ass off and you're going to either increase how much you're making or you're going to cut back on expenses and you're going to sell anything that's not nailed down in your house that you can afford to get rid of. And you're going to quit buying stuff that you can't afford and you're going to live within your means. I know that's easier said than done, right? No, I've been there. Started out 400 square foot studio. I had a child in a 400 square foot studio, guys. I know what it's like to live really, really cheap. But the whole reason you're doing that is so that eventually you don't have to work. Your assets will take care of you. That's your passive income goal. So the 3 steps to creating a passive income empire is number 1, follow that 70-30 rule. And now I'm just going to eke it out for you. 70-30 rule means live off of, this is take home. This is after whatever comes into your checking account. Look at your checking account. It's not going to lie to you. How much did I put in you this, this month? And if it's $4,000 a month, great. Then you're going to live off of $2,800. And you're going to take the other and you're going to do 10% giving, 10% debt, 10% invest. And I'll show you what you're going to invest in. It's really easy to get started. Painfully easy to get started. And then you're going to go, why didn't I do that? It's like, I could have had a V8 if you remember that commercial. So here's the deal. A lot of people, the giving is just not going to be possible. Like, you're living off of every dollar. I get it. I've been there, know what that's like. And I'm going to say donate some time. You got to give it to other people. And it's not just because I'm going to be altruistic and I'm going to pump around and pound on a Bible or anything like that. No, it's called being a decent human being, but also you meet other decent human beings when you do this stuff. If you start working with charities, guess what? People that tend to work around charities tend to be really decent people, and people that support charities tend to be rich, or they tend to be givers. You want those people in your life. You don't want to just be surrounded by takers. You want to be surrounded by givers. Be a giver and go to places that givers go, right? So if you're giving 10% to your church and you hang around your church all the time and they have a food, soup kitchen, or they have a food pantry or whatever else, and you can't afford the 10%, by all means, say, hey, you know what? I'd like to put a little bit of time in. I did that. I used to run a forklift for Northwest Harvest when I was going to school. I didn't have any money. So I figured, hey, you know what? I better try to do something for somebody else. Do that. But that 10% is the magic. Believe me, it's probably the most important one. It goes under the radar. Nobody talks about it. Realistically, you got to do that. It makes you feel better and it opens you up to making more money. If you're doing good for others, it's really hard to feel guilty about money, because whatever it is, we have this weird thing where like this money is the root of all evil going on. And that is just absolutely not the case. It's if you love money too much and you start ignoring your fellow man, then you could end up being pretty miserable. And frankly, there's a lot of rich people that are miserable. My buddy Hans calls them rich, miserable bastards, right? And we all know them. Money doesn't make you happy, but it can certainly lessen the blow of reality. And it's a lot better than being poor if you can get there, right? But it doesn't mean that's all you're focusing on. It means try to be a good human being too. Debt, 10%. We got to pay down our personal debt. You're in servitude of others if you are paying off a ton of personal debt. I'm not going to say you're never going to have it. The reality is you get out there, especially if you're young, it's hard not to. They're always pushing debt on us. Hey, 180 days, same as cash. 6 months, 0 interest. A year, 0 interest. 80% of those default, meaning that they don't pay it within that year. The credit card companies know this, and they're just trying to get you to buy something you can't afford. So don't do it. If you did do it, pay it down, right? Last 10%, invest. In fact, that's the most important thing you could do. Is every time you have a paycheck, take 10% of it and put it in an investment account. I don't care if you open up a Robinhood, a Schwab, TD Ameritrade, doesn't matter. Fidelity, pick your flavor. They have no cost accounts where you can actually start trading, and put 10% in there. Pay it like it's a bill. It's no different than a cell bill. It's no different than your rent. Just make sure that you're paying it. So that's step number one, is the 70-30 rule. I could give you a whole bunch of other little rules too, but it's just following that. If you can do that, you're going to be much better off, and follow that simple recipe your entire life. You're going to be way better off. As you increase your income, make sure you're following that. If you are just getting started and you're like, Toby, but I only make X and I can barely get by, minimize as much as you can. Figure out what you need versus what you want. Or better yet, go out there and find a way to make money in the area that you're going to be investing in. So if I was just starting out again, I would more than likely just focus on wholesaling on real estate, maybe trying to find mobile homes and things like that that are in high demand that I could flip. And if you don't know what those things are, stick around, go onto my site, or better yet, go to Infinity Investing. It's a company I work with a lot, and they do a really good job at breaking it down. I wrote a book called Infinity Investing. You can check that one out too. But what you're doing there is you're finding things for people that are investors. If you find something for an investor, they'll pay you for it. So wholesaling is finding properties, going out there, knocking on doors, putting up bandit signs, talking to anybody you can, going to the real estate groups, looking for deals. And if you find one, you'll get paid for it by being called a wholesaler. And it is legal in all states except Illinois. So like you could pretty much do this all over the country. But what you're doing is you're saying to somebody who's an investor, what are you looking for? And then you go find it for them. This is a recipe, by the way, guys. So if I was baking a cake and I was following a recipe and I was substituting things, like I'd be like, oh, here's the flour. But instead of flour, I think I'd like to use sand. You're not going to get a very good cake if you start swapping these things out. So this is a recipe. You got to kind of follow it, right? You got to make sure that you're doing it. If you want to live off of less, by all means, if you can live off of less, that's great. There's something called financial independence, retire early, the FIRE methodology. And they're big bullish on this, realizing, hey, you know what? If I could live off of half of what I take home, then I'm going to be able to retire much, much faster. I'm going to push that money into investments. That's the goal. If you're done with the giving, like if you're giving your time, so you don't have to worry about that, lower that one down to here. If you pay off your debt, lower that down to here. So eventually you're going to be investing 30% of whatever your take home is at a minimum consistently. But the markets crash and this and that. I don't care. Nobody can time the market. The very best investors on the planet say this over and over and over again. Quit listening to all these gurus out there spieling hey, I can teach you how to trade options and make $1 million. No, they can't. Statistically speaking, 99% of the people lose money when they play that game. And there's big studies that have been done on it. Warren Buffett, Charlie Munger, two of the best investors on the planet, will tell you over and over and over again, do not try to time the market. Just keep buying great companies at a good price. And just keep like, hey, if I use it, buy it. This is not a investment video, but I will say, if you just buy what you use, you're pretty good. So like, hey, I have stuff that I use every day: Starbucks, Chevron, Procter and Gamble. I like to go to Lowe's or Home Depot. I like to go to Target, Albertsons, whatever. Start buying those companies and their stocks, and just keep buying them over time. It's called dividend kings, dividend aristocrats. Do all that, and I'll show you why. Step number 2. We're going to diversify. We're going to build where this money is going to go to. This is going to flow in eventually into this. And I'm just going to give you the rule. I call it 30, 30, 30, 10. 30, 30, 30, 10. 30% of your money should be in income producing stocks. And notice that I said income producing stocks. Hopefully you can read that. It says stocks. 30% is going to be invested in something that is involved with real estate. And I'll explain that in a second. 30% is going to be managed money. And I'm not saying you have to go hire a property manager again, or a manager. I'll get into this. And 10% is cash or cash equivalents. You follow this, it's hard to get killed during the market downturns or anything like that. It's really hard to get hurt. So let me go through these each at a time. And I'll explain where the passive income comes from. The place we're going to start is right here, stocks, because we can start with this, $100. We can start buying stocks for literally even less than that nowadays. You can do your Robinhood, again, your Schwab, TD Ameritrade, Fidelity, fill in the blank, whatever it is. You're going to start investing in stocks, but not just any type of stock. You're going to invest in what are called income producing stocks, dividend kings, dividend aristocrats. If you've never heard of those terms, what I just said are companies that, if they meet that criteria, they're of a certain size, over $1 billion, that have been paying out dividends, increasing dividends, which is the profit they make and pay to shareholders, for 25 years or more. Dividend kings is 50 years or more. Dividend kings are your Procter and Gamble, your Coca-Colas. You can even have, I think, Altria sitting in there. You have even Federal Realty Trust, even a REIT, which we'll explain in a second. All these things have been increasing their dividends. 3M, Johnson and Johnson, even Tootsie Rolls sitting in there. But these are companies that for 50 years increase every year the amount that they pay their shareholders. So if you buy a share, they're going to pay you for owning those shares. It's called a dividend. As a tax attorney, I can tell you that if, depending on your income stream or what your income is, you could be paying 0% on that money. If you're married filing jointly and after your standard deduction, let's just say you're making less than $100,000, you're paying zero. Then it goes to 15%. And then if you're a rich person making over like $500,000, you're married making over, I think it's $517,000 this year, you're going to pay then 20% on any amount over that. But you're paying 0, 15, or 20% on dividends. They are tax advantage. The IRS is telling you, invest in these. That's where you start because it's so easy. And you're going to fill this bucket up to about $50,000. As you're doing it, you're taking 10% and you're dumping it into cash, your emergency fund. I'm sure you've all heard that. Oh, I have a 6-month emergency fund. I'm cool. Like, I want you to have a 6-month emergency fund, but I can turn stocks into cash in about 2 days. So I'm okay just saying 10%. So if you're putting in, let's just say that you're starting out and you have $300, you're going to take 30 of it and put it into cash and just in a regular checking or savings. You're not really getting anything on it. If you feel like you have to buy some crypto or something, maybe that, or I need to buy gold, then that's your cash or cash equivalents. I would suggest that if you're just getting started out, you just leave it as cash. The 270 will go into stocks. And then you're going to do that every month and you're going to let it build up. Eventually, you're going to have $50,000 of value in there. And then you move to the next one. And the next one is real estate or real estate equivalents. I'm going to suggest that you start off with REITs, real estate investment trusts, which are traded just like stocks, but they're real estate. Federal Realty Trust, Public Storage. These are big ones that you could buy, and it's just like owning real estate. Typically, a REIT has to pay out 90% of its income every year. So you're going to get a nice cash flow. You're going to get this money. It's going to come in every quarter typically, and you could see exactly how much you're going to get. Like, you could look at their yields. And the beautiful part, if you do like Federal Realty Trust, is great. Over 50 years, they've been increasing that amount. So if I bought something and it was paying me 3%, that's just going to go up, sometimes quite a bit. Like, some of these are averaging close to double digits what they increase their dividends, not the stock price, but the dividend that they're paying you. So every year it goes up. So when I started, hey, it was paying me $1. Now it's paying me $1.10. Now it's paying me $1.30. After 10 or 20 years, it's paying you probably more than you bought it for. And that's what you want. And then it's going to keep doing that. That income stream never stops. Don't sell it, right? When you start building these things up and start buying assets and they pay you, why would you get rid of it? It's a perpetual income stream. It's going to pay you, your kids, your grandkids, your great-grandkids. You want to hold on to these things. And I'll show you some ways to make some additional money on it. If you do not know what to invest in, again, Infinity Investing wrote the book, but it's a great course. Infinity Investing is free. You could go in there and see the ratings and what you could invest in. You could literally go in there, sign up, and they'll give you a great idea of where to start. If this is you, good place. Not just because it's something that I helped invent, but because it actually works and it's based off of, again, looking at very wealthy people who make money consistently year after year, 25 years of looking at returns, I can tell you this stuff works. Third category, which is where you got over 100, but you're going to do 50,000 there. Again, taking 10% and always putting it into cash. And then once you hit $100,000 saved up, you're going to go to the third category. The third category is managed. And managed money, real simple, just means somebody else's control of the investment. So it could be, hey, I'm gonna mirror somebody's stock portfolio. I'm gonna look at Berkshire Hathaway. I'm gonna buy everything that they have, or I'm going to hire a money manager and pay them 1%, which is about what you do, and let them, put my money into different investments, ETFs. I'd probably avoid mutual funds, but you're going to go into something where maybe it's buckets of stocks, this, that, and the other. I might even be doing private placements where I go into private investments. I'm starting to get big enough. I have to meet a certain threshold and be considered an accredited investor, but I might go into some of those things where, again, maybe you're a doctor, maybe you're a dentist, maybe you're a consultant, lawyer, somebody who's high income, and you qualify as an accredited investor, and you say, you know what, I just want to do private placements. That's where you do those, is in that third category. And then every year you just look at your portfolio and say, hey, how am I allocated? If I'm sitting here and I have a whole bunch of real estate and I have 60% in private placements in real estate, I'm okay. But if I'm 100% or 80% in real estate, I might be going, hey, wait a second. I'm too heavily, I'm too much into the real estate realm. I need to buy some of these income producing stocks and maybe spread it out a little bit. They call that diversification. I'm not huge on diversification the way that is typically described, but I do like this. I do like having a multitude of assets. We call it different streams of income. I have dividends coming in. I have income coming in off of real estate, which could be rents. This is passive real estate. I'm not going to be managing these things myself typically. Sometimes if that's something that my family likes to do, maybe I dive into it and manage it. But for the most part, you're just going to be sitting back getting rents and dividends. And then over here, I'm probably getting some combination of those two as well. Those are the two big ones, rents and dividends that I want. Now, can I make more money off of these investments? Yes. On the stocks, for example, as you start getting bigger and you get more money in your account, you can do what's called buying or selling a put. So I could sell a put to enter into a position. And it's called a cash secured put. I don't do naked puts. But what you're doing is you're selling somebody the right to make you buy a stock. So if you like Coca-Cola, for example, and it's around $50, I can sell a put that says, hey, you can make me buy 1,000 shares or 100 shares of Coca-Cola. I'll use 100 just to make it easy. So I know that I have $5,000 that I would buy Coke for right now, but maybe I could sell that right for somebody to make me buy it for 5,000, but I could get an extra $200. And then if Coca-Cola doesn't go down, guess what? I get to keep that money. I could do that month after month. That's number one. I could do that. That's easy. If I don't want to go there, like if that just went right over your head, don't worry. There's an easier one. If I buy a stock, I could sell someone the right to make me sell my stock to them at a higher price. So if I bought Coca-Cola at $50, I could sell a call, which is an option where I say to somebody will buy it, says, hey, for, let's just say it's for $1 and I'll sell you Coca-Cola at 51. I still made a profit and I get to keep the extra buck, right? I can do that every month. That's called a covered call, and it works really great. That's going to be short-term capital gains. So you remember I said there's 5 income sources? That's it. It's rents, royalties, dividends, interest, and short-term capital gains. That short-term capital gains is on the sale of options. That's all you're doing. It's called a covered call. It's not rocket science. It's something really easy to do. And again, you could even do securities. You could do a package of stocks where somebody does that for you. There's actually what are called ETFs, little groups of stocks that have these strategies too. So you could do that, make extra money. So I'm not worried about the stock going up and selling it to make my money. I'm literally getting paid on the dividend and I'm literally getting paid on the option. And it could be a chunk of money. You could start doing this after 2 or 3 years of owning a portfolio. Then you look back and you go, whoa, compared to what I paid for that, or 10 years, it's like it's extreme. You're looking at it going, whoa, I have been able to, over the years, pay off all my investments. These investments are literally buying themselves at that point. That's when you know that you have a passive income machine. When it starts perpetuating itself, whether you're working or not. Like, hey, I have this 30% that I'm dumping in, and I love to do it, but it's weird. It's growing a lot faster and it's starting to buy itself. That's exactly what you do. Step number 3, you lever this. And what I mean by levering this is you don't sell it. If I need extra money to buy additional things, I need it. I'm not going to tell you not to buy a Lamborghini, right? I'm just going to say you're not going to go into debt personally to buy the Lamborghini. You're going to let your assets, as it's churning out income, pay for those things. But let's say that I have a stock portfolio, my real estate's gone up, everything's doing conky dory, but I want a Lamborghini. And Toby's telling me, don't buy it yourself. What you do is you lever these assets. So let's just say I have a stock portfolio. Did you know that you could borrow against your stock portfolio? It's called a security backed line of credit. They'll generally give you up to 70% of your portfolio value. I would not do that. I would go maximum of 50%. But the interest rate's really low. It's like 2%. Even when mortgages are 5%, it's 2, 3%. I can borrow that. I didn't sell my security. It's still making money. It's still like the dividend could be that high. Literally, like the thing is paying for your own loan that then you use to go buy whatever car you want or a better house or whatever. It is not taxable. It's a tax advantage position. I borrow from my own portfolio. I go buy my Lamborghini and the stocks pay it off for me. 100% legal. That's what the rich people do. Buy, borrow, die. That's the strategy. You'll see it all over the place. When you start talking about rich folks, that's the strategy. Buy things, let it appreciate, borrow against it, and then die. And the reason that I say die is because the basis steps up. Your heirs can sell, pay off any loans or anything else, and pay zero tax. You get that money all during your lifetime for tax-free. Nobody pays tax on that growth. Buy, borrow, die. Congress keeps looking at it going, hey, how's that fair? That is exactly what we want people to do. It's not a fairness issue. It's the tax code is built to incentivize this behavior. Why are we not all doing it? So you can lever your securities. You can lever real estate. Everybody knows that because they buy their house and they get a mortgage. That's just levering an asset. The loan is one thing, but it's secured by that property. I could use I have my house. I own my house outright. A lot of you guys do. I'm saying I'm not a big fan of personal debt, but I can get a HELOC against my house. I do. If I need some cash to go buy something, even another investment, I could pull that out easy and access it. Now, I'm not going to say do that on your personal stuff, right? Now, if you want to go buy, like, hey, I need cash because I want to buy 3 rentals and they're a really great deal, I don't mind you tapping your personal residence to access that cash because your properties are just going to immediately pay it back, right? I could be levering the properties I'm buying. But what I would prefer you to do is look at your actual assets you already have that are investment assets. So if I have an investment portfolio, I have an apartment building, I have a bunch of single family rentals, borrow against those, get a loan against those, and then I have free cash, and then let them pay that back out of your rents. In other words, somebody else is paying it off, not you. I have something like I have an apartment building and it's appreciating and it has rents coming in. That's fine. But what I can do is borrow against the apartment building and go buy more assets. Or if I want to buy a car, I can do it. Or if I want to have a bigger house or I want to go on vacation, I could do that too. But at the end of the day, I'm not paying it back. My tenants are paying that back. That's the secret sauce. Step number 3 is do everything in a tax advantage way. Do not sell. The only time you sell something if something major happened on that particular investment. So let's say that you have a stock that's paying out a great dividend and for whatever reason they get ensnarled in some sort of shenanigans or they're acting, they change their complete business model and you don't agree with it, it's no longer a good company, then dump it. Okay, I get it, get rid of it. Or if it's a piece of real estate and it burns down, I might say, you know what, I'm going to take the insurance money and I'm going to sell it to somebody, but I'm not going to rebuild it myself. That's okay. Otherwise, you're holding on to these things forever. That income stream does not go away. If I have a portfolio like this, it's just going to keep paying me. And it doesn't stop. It's just going to keep doing it year after year, decades upon decades. And it's not just me. If I want to leave it to my kids and things like that, I'm leaving them not just a lump of cash. I'm leaving them a nice cash flow machine. So these are the 3 steps that I would do to build a passive income empire. I have done it. It does work. I watch my clients do it all day. None of this is an original idea from me, by the way. I am just the conduit. I see people who are doing these things. I see them consistently having great results. And I suggest you do the exact same thing and ignore all the hoopla out there, the people that are trying to get you to buy and sell, and markets are crashing and now's the time to buy and all that stuff. Get rid of that nonsense. Buy systematically over time, ignore all the hype, buy great companies that are paying you to own them, that have free cash flow, and they share it with their shareholders. Don't buy growth companies that make no money and you hope that they go up in value someday and you sell it. That's a recipe for disaster. Those are the ones that get crushed when there's a downturn. Cash flowing companies, great companies that make money, don't get affected at all. Then when it comes to real estate, you're buying cash flow real estate. You're not buying liabilities, you're buying assets. I don't care what the economy's doing. Like, I remember here in Vegas, I live in Vegas, market crash. We had this huge recession. We were ground zero for foreclosures. Our rents went up our rental properties made more because people that were losing their house, they had to live somewhere. If you have, it's supply and demand. Rents tend to go up over time. They've consistently gone up. You can't say that, boy, I wish I hadn't bought that rental property in 1970. You're killing it. You bought it in 1990. You're killing it. You bought it in 2000. You're killing it. You bought it during the recession. You're killing it. Right? All of those have done absolutely great, but somebody was trying to get you to sell it at some point during those times. And if you'd made the mistake and sold, you're regretting it. So you hold on to these things. So step number 1, live below your means. Make sure that you're paying an investment account. Step number 2 is do the 30, 30, 30, 10. 30, 30, 30, 10. Yeah. Income producing stocks, real estate, managed money, even mirroring somebody's portfolio, 10% in cash. Step number 3, don't sell, lever the asset to buy more assets, and or to buy things that you want to live off of, but make sure that you are not paying it from your efforts. You're letting somebody else pay those things off. If you like this type of content, by all means, please like this channel, subscribe to it by clicking that little bell. You don't get hit with spam, but it lets you know when new videos come out. If you think somebody could benefit from this, please share it, and then give me your comments below. Thanks, guys.